why is the allocation for emerging markets so low? What is it? Is it like a xenophobia? Is it a lack of awareness?
I would say it's probably certainly both of those, at least.
Thank you for being honest.
At a certain level, I think that there hasn't been that many opportunities.
Yeah.
Or as many opportunities. Emerging markets are risky. I mean, there's a lot of risks in the world.
Sure. Deep Dive with Dastagir is a series of industry events, both online and in person, to try and catalyze conversations that will move the needle forward in the industry in terms of learning and innovation. And secondly, which is I think more important to me personally and closer to my heart, is that we really want to foster more and more community within the ecosystem. We have very few events locally that are few and far in between. So we think it's important to have something on a more regular cadence. To all my Lahori friends, I'm really sorry that it took me so long to come back here. I've been doing back-to-back events in Karachi, but hopefully we'll do more of these as we move forward. For those of you that don't know me, I'm Saif. I'm the executive director of the company. I do comms, partnerships, government relations, investor relations, basically anything that doesn't have to do with business or product, because I don't know anything about those things. And today we have a very special guest. We have Mr. Kevin Carter. He's visiting us from the US, first visit to Pakistan. So please help me make this memorable for him and give him a warm round of applause. So Kevin, can you give us a quick intro on your career journey, what all you've been doing? I know you've had an illustrious career history.
Thank you all for coming out. I'm so excited to be here. I've been planning and thinking about this trip for a couple of years now, so it's very exciting for me to be here, and I really appreciate you coming out and for your help. So let me tell you about myself real quick. I live in San Francisco. I actually live 15 miles east of San Francisco. I've lived there my whole life, except for a few years off in college. And I graduated from college in December of 1991, and I showed up in San Francisco for one interview that I had with an investment bank called Robertson Stephens and Company, which some of you might remember, but probably not many of you. We used to call it the Goldman Sachs of San Francisco. Now young people think that Goldman Sachs is evil, so we don't say that. But it was the premier technology-focused investment bank, and I had one interview, and after the interview, the guy said, okay, you can start Monday. And I said, well, how can I start Monday? I don't know anything about investing. And they told me to go buy a book called A Random Walk Down Wall Street. Does anyone know that book? It was first written 50 years ago by a Princeton economist. And in 1972, it was written. And in the first edition, the author suggested that somebody should make an index fund. There were no index funds back then. And so the person that wrote that book is one of the sort of founding fathers of the world of indexing and also of ETFs. He also was the chairman of the group that made the first exchange-traded fund. So anyway, I started by reading about indexing, but in 1998, I was a very cocky young value investor, and there was all of these new technology companies that were called .coms, including one named Amazon.com, and I thought it was way overvalued and that people should short the stock when it had a $1 billion market cap. And I told people to short the stock, and I wrote a research report about why people should short the stock. And I shorted the stock, and in about a day and a half, I lost a third of my money. But the same week that happened, I saw another company change its name to add .com to its name, and the stock had been $1 a share, and it went to $30 a share because they added this .com. And I said, oh my gosh, I've read about this. And I found that book I mentioned, A Random Walk Down Wall Street, that was on my bookshelf. And it turned out that there'd been a bubble before in technology stocks in the 1960s. And then in 1999, I decided I wanted to save the investment world, and I started an online brokerage firm called E-Investing, which was the first brokerage firm that let people buy stock in dollar amounts instead of share amounts. I asked that Princeton economist to be an advisor because I was young and I needed money, and I didn't go to Harvard or Stanford, and so to get some credibility, I asked him to be an advisor to me, and he agreed to do that. And we sold the company to E-Trade in the year 2000, and then we started another company that did what's called direct indexing. So rather than buy an S&P 500 index fund, you could build your own custom S&P 500 with the individual stocks. And we sold that company to Natixis at the very end of 2004. Natixis is a French bank that owns a bunch of US money management firms. But right before we sold the company, Google went public. And a few months later, my phone rang, and it was a guy from Google. And he said, hey, I heard about this active indexing. I want to make my own custom, S&P 500 strategy. And I said, well, I don't work with individual investors. We're available at some of the larger investment banks and brokerage houses. And he said, well, I don't want to work with one of those. I want to just invest straight with you. And I said, okay, well, I'll have lunch with you. So I drove down to Mountain View and had lunch with this kid. He was 25 and I was 30. You know when you misspell a word in Google and it says, did you mean? He wrote that. So anyhow, he talked me into becoming his advisor, basically. And then he started introducing me to other people. And so next thing I know, in early 2005, I'm driving from San Francisco to Mountain View once a week to meet some new Google person. But meanwhile, my partner at Princeton, he starts going to China. A couple of his Princeton economist buddies were Chinese, and they had gone back to teach economics in Beijing. They called him and said, Bert, you got to come see this. And he starts going to China, and he ends up writing a white paper with these two guys, making the case for investing in China. And the Google people found out about it and called me and said, hey, can Burton come talk about investing in China? And I said, sure, next time he's in San Francisco, we can do that. And that was 17 years ago. We drove down to Mountain View one morning, and Burton gave his talk, and then all these people looked at me and said, we want to invest in China. And I had no idea what that even meant, but somehow from that moment until today, my entire professional life has been figuring out how do you invest in emerging markets, not just China, but all emerging and frontier markets. So that's how I got involved with emerging markets. So in the investing world, there's sort of two camps. There's the active camp, which is I'm really smart and I think Microsoft's going to go up and you should sell Dell and you're going to pay me 1.5% to do that for you. Now, those are the active investors. The passive or index investors say, I'm not paying anybody 1.5%. I'm going to buy all of the stocks and just hold them. And I'm going to save that 1.5%. And if you're making 11% a year and the fund manager takes 1.5%, then you're going to make 9.5% a year. And I'm sure a lot of you understand the miracle of compounding. After 20 years, there's a big difference between 11% a year and 9.5%. So the index fund, which is just because there's almost no fees on index funds, traditional index funds, they've been taking over from the active funds. An exchange-traded fund is an index fund that trades on the New York Stock Exchange or the NASDAQ, and it has some tax advantages.
You then launched EMQQ some 9 years ago. Which is an ETF that focuses entirely on emerging markets. So I want to understand, and again, it's important to give context to our colleagues here, that it began with this sort of fascination with China for a lot of your Google friends and a lot of your other peers. What spurred that on forward to include all these emerging and frontier markets?
Sure. So in the first 8 years, we launched some China ETFs with Guggenheim. But I spent most of my time in Boston and New York with family offices and foundations and endowments. And what we realized pretty quick was, and Americans don't like a lot of other countries. They're afraid of other places, and they're very ethnocentric. And in particular, Americans really are afraid of China. And so what we used to say is if we called 100 institutional investors and said, would you be interested in a China strategy? 5 of those 100 would say yes, and 80 of the other ones would think we're trying to steal their money. But if you called the same investors and said, are you interested in emerging markets? All of them would say yes. And so what we realized was, when an investor makes an asset allocation, a pie chart that says, I'm going to put this much in bonds, this much in stocks, nobody has a slice for China.
Why?
It's too narrow.
Is it a political issue?
It's just not the way they've done it historically. Right. Okay. You get lumped in as an emerging market. So,
even though it is the biggest.
Even though it's the biggest and the biggest by far.
Yeah.
And there were people back then that would say, well, China's so big, how can it be an emerging market? And you say, well, it's not the way it works. The way that you get defined is by what's the average income. And if you have an average income in your country of $25,000 or more, you're developed.
Yeah.
If you're below that, down to 5,000 or so, you're emerging. And if you're below that, you're frontier. And so China, as big as it is, its per capita income is still only halfway to 25,000. So it's the people that are emerging, right? You've got billions of people. Their incomes are going up, and they want stuff. They want more and better food, more and better clothing. They want appliances. They want to take vacations. And so I was trying to tap into that. But what I realized about 8.5 years ago was that the best consumer companies were not called consumer companies. And when this device showed up, I could see how consumption was changing in my family. The e-commerce companies are actually the future of consumption.
Yeah, makes a lot of sense.
So we have EMQQ is our main fund that owns. We invested all 46 emerging and frontier markets. China's the biggest part of that. Yeah. We have a newer fund that is the same thing, but without China. And we didn't make it because we don't like China. We made it because China is an emerging market in a traditional sense, but if you were going to recategorize all 46 countries by smartphone use, by e-commerce, by digitization, China's the most developed country on the planet by a mile and getting further ahead. And if you look at the revenue for the emerging markets internet sector, which is what we track, it's 80% China so far. But the other 20%, those 45 emerging and frontier markets, they have 5.5 billion people. Yeah. And they're just getting their smartphones basically today. And so we call it the third wave. You had the US, internet consumption wave started about the year 2000 when people first had a personal computer and you could plug that computer into the internet. And there was a browser that showed up in 1995, and you could open that browser, and you could, for the first time, go on a website and buy something or sell something. And that started this 15-year S-curve as the so-called FANG stocks, the Amazons, the Googles, the Facebooks, they took over our lives and our stock market. So that was the first wave. The China wave was right behind the U.S. Alibaba, Tencent, Baidu actually went public before Google did. And that wave, you call it 2005 to 2020, the second wave. And now there's a third wave coming, and this is the third wave. And it's going to be bigger, I think, than the first two waves because there's 5.5 billion people in the other 45 emerging markets. And so I think the next 15 years is going to see this incredible S-curve of growth as those 5.5 billion people get their first smartphone, which gives them their first internet access. And because the emerging market consumer doesn't have the consumption infrastructure that we have, first and foremost, the bank accounts, right? I go into a store, there's a chip reader on every counter, and everybody has a credit card or a debit card. Well, most emerging market consumers don't have that. And so they're leapfrogging to digital.
Which plays or which verticals are thriving more in developed markets, in emerging markets, in your opinion, based on what you've seen?
Well, the fintech. Very broadly fintech. You need the plumbing to be in place. And And you need the payments to be in place. I mean, the payments, getting the money on the phone, that's the gateway.
Yeah.
And once you get the money on the phone, then, and you've seen this in China with Ant Group, once you get the payments, you can get into all sorts of financial services. You can sell investment products, you can sell insurance products, and you can do banking and lending, which is where there's a lot of profits to be taken from the existing players. So that fintech is very clearly the biggest part of it, and you see it in the numbers and what's getting funded. How many of you know Mercado Libre? This is the e-commerce leader of Latin America. They call it the Amazon of the Amazon. And it started as an e-commerce player, but people were paying with cash. And they said, well, we have to set up, this is not going to work, we need a payments platform. All of a sudden, Mercado Pago becomes the bank, and just in the last couple quarters, Mercado Pago's, the fintech part of Mercado Libre is now as valuable as the original business. And you're seeing this all over emerging markets. And you don't see that in the United States. I don't have a bank account with Amazon.
Yeah.
Right? I don't get insurance from Amazon.
You don't need it. You have the rails.
That's right.
Yeah.
We have a very developed consumption infrastructure.
Yeah. It's interesting. So comparing regions a little bit based on your experience in emerging markets worldwide, what are the parallels between Latin America and Asia? And something I'm really curious about. What's working there that maybe we're not paying attention to, or vice versa?
Sure. So this trip that I've done here in South Asia, I started in Dhaka and went through India. This is my final stop. I did a similar trip a year ago to Latin America and went to Mexico City and Bogota and Buenos Aires and Sao Paulo. And I saw all of our companies sort of on the ground. And I would say a couple things. First of all, Southeast Asia looks almost exactly like South America, Latin America on paper. 650 million people, about the same age, about the same income levels, about the same smartphone and e-commerce penetration. South Asia, which we define as, again, the subcontinent from in the east, Bangladesh, India, and Pakistan, that is, first of all, a huge number of people. I mean, that's 1.8 billion people. So that's 1.5 times the size of Southeast Asia and South America combined.
Yeah.
And it's young, 850 million people under the age of 30. So you've got a big young population and with a lot of tech talent, and the income levels are lower.
But there's a burgeoning middle class.
There's a burgeoning middle class for sure.
Yeah.
And while India has a pretty well-developed venture market, the per capita venture dollars that have been deployed here and in Bangladesh are very, very, very low. And so I think, and that's, I guess, another thing that I didn't really appreciate until I started getting ready for my Latin America trip. Before I went, I did some pretty deep dives with a few of the venture investors I know that specialize in the space, and I think some of them have investments in some of the people here in this room. But one of the things I didn't appreciate was how little venture capital goes to emerging markets.
Yeah.
And if I remember correctly, I think Europe, like stodgy old Europe, gets twice as much venture capital as all 46 not counting China, all 45 other emerging markets. I mean, it's like tiny versus what goes on. And now there is, most people in this room know, there's been some headwinds in venture capital, and a lot of the private market valuations have gone down.
Yep.
But when I went to Latin America, the data showed that 10% of the venture capital went to emerging markets, but more than half of the unicorns came from emerging markets. And so I think that almost for sure one of the things we'll see is that will change.
You're based in the US, you're speaking to investors all the time, both in private and public markets. Why is there this perception about emerging markets? Why is the allocation for emerging markets so low? What is it? Is it like a xenophobia? Is it a lack of awareness?
I would say it's probably certainly both of those, at least
Thank you for being honest.
at a certain level. I think that there hasn't been that many opportunities.
Yeah.
Or as many opportunities. Emerging markets are risky. I mean, there's a lot of risks in the world.
Sure.
The venture capital market will catch up. And again, that was, this year and last year, there was a decline in every region except for Africa in terms of venture funding. But
except for Saudi.
Okay, well.
Saudi actually beat Africa.
Okay.
In terms of year-on-year growth.
Okay, well.
In 2022, they hit $1 billion in venture funding.
Okay, well.
I'm bullish on Saudi. It's a thing.
Yeah.
It's a thing.
So I just don't think the apparatus was there.
Yeah.
It's hard for investors to know where are they going to put it. I've made a point to try to get to know as many of the venture funds that are focusing on this part of the world and other of the emerging and frontier markets. There's not that many of them.
Yeah. Do you
like
work
yours.
with those emerging market focused VCs because they're ultimately in the same value chain as you? They're creating the same valuations that will propel companies to IPOs that will eventually end up in your ETF.
So I'll tell you a funny story about this.
All right, here we go.
So when I first had the idea, my light bulb moment for the emerging markets internet ETF EMQQ, the first thing I did is I went back to my desk and I Googled emerging markets internet index to see if anybody else was already doing this.
Yeah.
And I was horrified when a website came up from a firm called Rise Capital. Anyone know Rise Capital?
Nope.
It was a brand new fund. It was headquartered in San Francisco, 12 miles from my house, and I went to the website. There wasn't much on the website, but there was an index, and an index is just a list of companies.
Yeah.
And the weights add up to 100. And there was a list of the 17 or 20 of these emerging market internet companies. I said, oh no, someone's already doing this. But then I went and I looked on LinkedIn to see who this person was. And when I looked at his bio, I thought, no, I don't think he's starting an ETF. And his background was that he was a co-head of internet research for Goldman Sachs. And then he was the CEO of the largest social network in Russia, which he sold. And then he worked at Tiger Global, and he was the third guy investing in startups there.
Okay.
And so I called him, and I said, can I meet you? So I went into San Francisco, and I said, hey, I'm starting this emerging markets internet ETF. He said, oh, that's great. I'm starting an emerging markets internet venture fund. And I'm going to do first round investing. And I said, well, that's amazing because I'm starting a fund. I'm doing last round and I'm doing IPOs.
Yeah.
And we said, well, if everything goes well, then some of the checks you write for the first check, some of those companies will work and they'll become part of my portfolio.
Yep.
And that's about to happen.
Really?
Yes.
Okay.
He's
Nice.
got several unicorns in Latin America. I spend my time marketing and telling investors all over the world about here's what's happening out in places like Pakistan.
Yep.
And these are real entrepreneurs and they've got great educations. And so I like to know what's going on with the venture guys. And they've also make a lot of good intros to me so I can meet founders and see what is coming down the pipe.
Of course. So we're speaking a lot about Latin America and the Mercados of that region. Pakistan's bigger. Pakistan's a bigger economy. It's a bigger population. We suck at rails and infra. So is that really why we don't have that first unicorn yet, in your opinion? What are they doing right? What is the mix of ingredients that I don't have here?
Okay. This is actually pretty fascinating about what's happened in Latin America. And the thing that's happening in all of these markets is a virtuous cycle that's happening. And this is the reason I'm so incredibly confident about this growth that's going to happen. Because this virtuous cycle, once it happens once, it's creating 5, 10, 20, 100 new companies.
Right.
And the virtuous cycle goes like this. First, and I'm going to make this black and white and simple, but the smartest kid from every country goes to Harvard or Wharton or MIT or Stanford or other great universities, and there's great universities in every country. So it starts with that. They go to work, they get their degrees, and they go to work for Google or Microsoft or LinkedIn.
Yep.
Then they go back to the best colleges and get their MBAs.
Yep.
And then they're getting funded by professional investors, US venture investors, increasingly local venture investors. And then they go to work. And they start to build these businesses, and they grow and they work and they grow and they work, and then they go public or get bought and create liquidity. And every time that cycle happens once, it's creating 10 new founders, 20 new founders, new angel investors. It draws in new venture money. And in Latin America, it all starts with Mercado Libre. So the founder of Mercado Libre, Marcos Galperin, he wrote the business plan in the library at Stanford University in 1999. The speaker at the graduation was a venture capitalist from Texas named John Muse. Marcos goes to the dean and he says, "Can I drive him back to his jet after he gives his speech?" And the dean says, "All right, Marcos, you can drive him." And on the way, it's a short drive from Stanford to the Palo Alto airport, so he must have gone fast. But he pitches his plan to go back to Argentina to start the Amazon.com of South America. Mr. Muse says, "All right, that's a good idea. I'll write you a check." Marcos and one of his classmates and another guy set up in a garage in Buenos Aires, and they start to build the Amazon.com of Latin America. And it works, and it keeps working. Now, this is a company that went public, I think, in 2007. It's still growing at 40% a year, right? Last year, they put up 41% revenue growth. So, and so what happens? The founders become billionaires. The early employees become centimillionaires or decamillionaires, hundreds of millionaires. And then, especially if they held on to the stock, I mean, the value's gone up and up and up and up. And then they leave. They say, "Hey, I've made some money. I'm going to go start my own company. I'm going to be an angel investor."
Right.
And that cycle, that miracle of compounding, it can't be stopped. And it all started in Latin America with Mercado Libre. Now, there's two other things that happened in Latin America that are to be noted. First of all, the group Endeavor showed up. How many of you know Endeavor?
Endeavor just showed up to Pakistan last week.
I know.
Yeah.
So Endeavor they did a pilot in 2 countries. I think it was Argentina and Chile. One of their first investments was Mercado Libre.
Right.
So that organization, their mission is to create the ecosystem.
Yeah.
And it literally is my favorite organization on the planet. It's like a nonprofit. Selfishly, it's a nonprofit that's building the EMQQ story, right? I mean, and so you had the presence of Endeavor, and then the founders of Mercado Libre, Marcos still runs the company, but a decade ago, the other 2 co-founders left and started a venture capital fund.
Oh.
And they've now invested in dozens of startups, including the second largest internet company, which is the largest online bank in Latin America, called Nubank.
Yeah. So given the recent debacle with the Silicon Valley Bank crash, can you first just summarize for us how public markets are reacting?
It's been very bad. And that first weekend, because I guess the whole thing went down on a Thursday.
Yeah.
And that weekend, I was in Bangladesh, and I was very worried because you could already see the potential domino effect.
Yeah.
And this incredible tragedy as well. I mean, this particular bank, and I'm sure everyone's read about it. I mean, they were the ones that were the bankers for the ecosystems. Yeah. And I knew that they were the bankers for the U.S. ecosystem, but what I didn't appreciate was that a lot of the emerging market founders who had been funded by Andreessen Horowitz or Y Combinator. I think Y Combinator had hundreds of companies.
That's right.
At Silicon Valley Bank. A founder or a startup that's raised 30 or 40 or 50 million dollars, and you've got some momentum, and you've got a great team, and there's energy, and you're moving forward, and then all of a sudden, the last thing you'd expect is all of your money's gone, right? I mean, that's would have been a tragic series of events, and I'm sure. And you read the stories about the founders that had that experience. Like I had $10 million in the bank and I couldn't get it. And so it seems that the government is stepped up and said, we're going to backstop this. But I don't know that it's over. I mean, we've already seen a couple other banks, and these are all banks that are in my sort of neighborhood, and First Republic and Silicon Valley Bank. And
well, First Republic is okay. They've got some liquidity injected from.
Well, they did, but I think the stock still is voting.
It's in free fall.
I mean, the equity investors seem to be voting that still maybe got some problems.
Yes.
But if you think like the tide's just going out on this, right? I mean, who knows what else is out there? What other banks? Because if you saw what they had a duration problem, right? They had short-term deposits, but they had long-term investments, and those went upside down pretty fast with the rise in interest rates. And you have to think that there's other institutions out there that have that problem.
Kevin, I think that's a good point. Close it up. What do you think? You want to open it up for Q&A?
Well, what's your opinion on valuations, right? So, for example, a SaaS company in Silicon Valley, it can be two people, one programmer, one seller, and they can get to $1 million ARR. But a SaaS company in the emerging markets to get to 1 million in ARR might need to do a lot more, maybe a team of 50, 60. So how do you adjust for this PPP disparity in valuations?
Well, there's no doubt that's an issue. I mean, I know that when I talk to investors, they'll say, well, yeah, there's 1 billion people there, but they've got this income level. And that's what it is. I mean, ultimately, the higher the incomes, first of all, the population size is one part of the math, and then the per capita income, and then the growth rate. But you start with a big population. I mean, that's the one thing that you have here is that you're the 5th largest population on the planet, and again, the South Asia has got number 1, number 5, and number 8. So you have that scale that most people don't have. So even with smaller, per capita incomes or consumer spending, the number of people is so large that the opportunity is enormous.
What I'm trying to understand is on the topic of what happened in Silicon Valley with the Silicon Valley Bank, right? So there was this instability, but there was a sort of structure that was ready to bail out or minimize the damage. When something like that would happen in a country like Pakistan that already has, like you mentioned, so much risk, what is investor perception on that?
Yes, I think it does. And and this kind of goes back to the PPP question. Emerging markets are risky. Pakistan, has had a lot of government and financial issues, significant ones, and I think it's also just it's a country that at least Americans, they don't know it, they don't know what it is really, but they shy away from it, I think. So I think those things come into play for sure. But especially if you have macroeconomic problems and debt problems, there's no doubt investors will not look positive on those things, and will make it harder to get venture capital, and will be harder on the valuations for the money that does come.
Please give it up again for Mr. Kevin Carter for being an amazing guest. An amazing speaker, sharing some really cool insights. I'm so glad he was able to join us. For the sake of the recording, the PPP question is purchasing power parity, not any other PPP. Huge thank you to Daftar Khan for being an amazing event partner. Huge round of applause for them. My first time working with them. Fantastic experience. And thank you guys for coming. That's it. You're home free.
Thank you.